Usually when we look at a price tag on something we buy every day, we just assume there's some kind of strict underlying logic to it, right?
Right, yeah, like it's based on something real.
Exactly. Take a gallon of milk. You look at the price, and it makes intuitive sense based on, the cost of the cow, paying the farmer, the
To
transportation.
refrigeration, all of that.
Yeah. It's grounded in physical reality. There's this tangible, verifiable cost of production that's basically holding that price in place.
Right, the math adds up.
But then you step into the financial markets, and suddenly that price tag just feels completely untethered from reality.
Oh, completely.
You see a company's stock price soaring to the moon, and you try to find the logic, the milk, so to speak, and you realize there isn't any. It's just pure hype.
Yeah, which is a terrifying realization.
It really is. And if you've ever felt that vertigo looking at your own portfolio, you are in exactly the right place today. We're taking a deep dive into what is universally considered the ultimate Bible of value investing.
Yes, Security Analysis by Benjamin Graham and David Dodd.
Right. And this isn't just some dusty old textbook, is it?
No, not at all. I mean, it is a foundational text. Graham and Dodd wrote the original edition back in 1934, right in the smoldering wreckage of the 1929 stock market crash.
The ultimate crash.
Exactly. They wanted to inject rigorous analysis into a field that had basically become nothing more than a speculative casino at that point. They desperately wanted to tether the price tag back to reality.
And we aren't just looking at that 1934 version today. We're actually jumping into the newly updated 7th edition.
Which is fantastic, by the way.
It is. It features incredible modern commentary by investing titans like Seth Klarman and James Grant. We're going to unpack how these principles forged during the absolute trauma of the Great Depression can actually protect your portfolio right now.
And that protection is so necessary today. Oh, absolutely. Because, let's face it, we are living in a wild era of tech disruptors, special purpose acquisition companies, cryptomanias. So whether you're managing a massive corporate retirement fund or you're just trying to figure out where to put your very first savings, this deep dive is designed to arm you with a specific financial superpower.
I love that framing.
Thanks. It's the ability to separate a true investment from a highly dangerous speculation.
Right. And I mean, that distinction is really the beating heart of the book. Graham defines an investment operation as one which, upon thorough analysis, promises safety of principal and a satisfactory return.
So try first.
Exactly. If it doesn't meet those specific criteria, it is, by definition, speculation.
Okay, let's unpack this, starting with the very core of value investing. Seth Klarman, in his commentary for this new edition, gives a remarkably simple definition of what this actually looks like in practice.
He does, yeah. It cuts right through the noise. He says value investing is basically buying a fractional interest in a business at a bargain price. Like, you are quite literally trying to buy $1 for 50 cents.
But to recognize that you're buying $1 for 50 cents, you first have to know what $1 actually looks like in the stock market.
Right. Which isn't always obvious.
No, it's not. And that requires understanding Benjamin Graham's concept of intrinsic value.
Intrinsic value.
Right. Intrinsic value is the true worth of a company, but it has to be justified by cold, hard facts. It is not based on market hype.
Or some charismatic CEO promising the moon.
Exactly. It's based on the actual physical assets the company owns, its proven earnings history, and the dividends it actually pays out.
The book highlights this fantastic example from 1933 that makes this crystal clear, I think. Graham talks about the J.I. Case Company, which manufactured agricultural equipment.
Tractors and things like that.
Yeah. So in early 1933, you could buy a share of this company for $30. But if you actually looked at their accounting books, the company had an underlying asset value of $176 per share.
176?
Right. So you have to ask yourself, why was the market offering to sell you $176 worth of tractors, inventory, and factories for a mere $30?
And the answer to that lies entirely in human psychology. J.I. Case's earnings were fluctuating wildly at the time.
It was a bumpy ride.
Very bumpy. I mean, one year they suffered a massive deficit of $17 a share, and then another year they generated a massive profit of $26 a share.
So the market wasn't, like, blind to the assets. They were just too seasick from the earnings to care.
That's a great way to put it. Investors just panicked at the uncertainty. They completely ignored the massive pile of physical assets sitting right in front of them.
They let temporary fear dictate the long-term price.
Precisely. And that is exactly where the value investor finds their opening. But Graham points out that determining intrinsic value isn't some exact to the penny science.
Right. He uses that wonderful simile about the overweight man.
Yes. He says determining intrinsic value is like looking at a man and knowing he is overweight without needing to know his exact weight to the pound.
You don't need a scale to see the obvious.
Right. You don't need to know if the J.I. Case company is intrinsically worth exactly $130 or $150. You just need to know that $30 is absurdly cheap.
It's like buying a used car.
Yeah.
You don't need to calculate the exact manufacturing cost of every single bolt in the engine to know that $500 is an absolute steal for a perfectly working sedan.
Exactly. And that $100,000 for that same sedan is a total ripoff.
Yeah. You just need a rough but reliable estimate of value to know when something is completely mispriced.
And finding that mispricing is entirely dependent on understanding the emotional instability of the people who are setting the prices.
Which means knowing what a company is worth is really only half the battle. To understand why these massive, seemingly illogical discounts ever happen in the first place, we have to examine the irrational humans doing the buying and selling.
We do. We have to look at the psychology.
And that psychological reality is perfectly captured in, well, probably one of the most famous maxims in Wall Street history.
Yes, Graham famously wrote, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine."
In the short run, it's just a popularity contest.
Completely. It's driven by fear, greed, and whatever happens to be trending on social media.
People are just voting with their emotions.
Yeah.
But over the long haul, the actual weight of the company, its tangible cash flows, its assets, its true intrinsic value that eventually forces the scale to balance.
Right. Because that short-term voting machine is so incredibly volatile and prone to panic, Graham introduced what are arguably the most important three words in all of finance.
Margin of safety.
Margin of safety. You are navigating an irrational market, and you yourself are a fallible human being who might make a mistake in your initial calculations.
You're not perfect.
Right. Therefore, you never want to buy a stock when the price is exactly equal to its intrinsic value. You demand a massive discount.
You want that margin of safety as a kind of shock absorber against bad luck, severe economic downturns, or just plain old human error.
Exactly.
And what's wild to me is that even the absolute geniuses need that shock absorber. One of the most stunning historical details in the text is that Benjamin Graham himself, the literal father of value investing, lost 70% of his joint account between 1929 and 1932.
70%. It is a profoundly sobering fact.
It really is.
But he didn't lose that money because he miscalculated the intrinsic value of his companies.
Right.
He lost it because he used margin debt.
Wait, just to clarify for anyone listening who maybe hasn't traded on margin, that means he wasn't just using his own money, right? He was borrowing money from his brokerage to place larger bets on these stocks.
Exactly. He correctly identified that his stocks were deeply undervalued. He thought they were so cheap they could withstand any economic blow. But he underestimated just how irrational the voting machine could get during a sheer panic.
The fear took over the market.
If we connect this to the bigger picture, when you use margin debt, you basically forfeit your staying power. If the stock price drops far enough, your broker issues a margin call demanding you deposit more cash.
And if you don't have it?
If you don't have it, they literally force you to sell your shares at the absolute bottom of the market to pay back the loan.
So Graham was forced to lock in those massive losses before the weighing machine ever had a chance to work and prove him right.
He was.
It brings to mind a very dark quote from Robert Lovett, a Wall Street partner back in 1937, which is highlighted in the text. He noted that, quote, "The only permanent investment is one which has become a total and irretrievable loss."
That's a haunting quote. But Graham's painful lesson completely changes how a value investor views market volatility.
How so?
Well, the average person sees a stock market crash and they panic. But a drop in price is not an actual loss unless you sell, either because your fear overwhelms you or, like Graham, margin debt forces your hand.
Right, it's just numbers on a screen until you hit sell.
Yes. If you hold a great business with no debt and the intrinsic value hasn't actually changed, a price drop is just a markdown.
Like the sale at a department store.
Exactly. It's the market offering you a chance to buy more of a great asset on sale. Volatility is actually the value investor's greatest weapon.
Okay, that sounds really great in a textbook. But practically speaking, when your neighbor buys a new boat because they got rich overnight on a hot meme stock, or your coworker's bragging about their crypto portfolio, how on earth are you supposed to stay rational?
It's tough.
Right. Fighting the fear of missing out, FOMO, it feels almost impossible. It's like an intoxicating drug.
You're touching on the hardest part of investing, without a doubt. FOMO is the ultimate portfolio killer. And because human nature never, ever changes, the exact same speculative euphoria that Graham witnessed in the roaring 1920s roared right back to life in the 2020s.
It's wild. If the 1920s had, wild, unregulated holding companies, the 2020s just had Wall Street legally dressing up hype in new acronyms.
Absolutely.
Let's look at SPACs, for example, special purpose acquisition companies. Graham's definition of speculation applies to these perfectly.
SPACs are a masterclass in modern speculation. Functionally, a SPAC is an inversion of a traditional initial public offering.
Okay, break that down for us.
So in a normal IPO, an existing operating business with real revenues and real assets goes to Wall Street to raise money from the public. But in a SPAC, a blank check company raises money from the public first, puts that cash in a trust, and then the sponsors go out looking for a private business to buy and take public.
It's essentially saying, hey, give us your money first, and trust us, we'll find something cool to buy with it eventually.
That is exactly what it is.
And during the recent boom, investors were throwing money at $10 a share, thinking they were getting in on the ground floor of the next big tech giant. But the text details a study by Michael Klausner that exposes this huge hidden trapdoor.
The math on SPACs is just brutal.
Right. Because of the structure of a SPAC, that $10 you invested was immediately decimated. The median intrinsic value of the cash actually left over to buy a company was diluted down to just $5.70.
Wow.
How does a share lose over 40% of its value before it even buys a business?
It gets siphoned off through massive hidden sponsor fees and complex financial instruments called warrants.
Warrants?
Yeah. The sponsors who set up the SPAC typically grant themselves 20% of the company's equity for almost nothing, just for organizing the thing. Then, early institutional investors are given warrants, which are essentially free options to buy more shares later at a fixed price.
Oh, man. So retail investors are just getting crushed.
Exactly. When you add up the sponsor's free slice of the pie and the warrants watering down the remaining slice, the retail investor is left holding the bag. It violates the core tenet of value investing entirely. Instead of buying $1 for 50 cents, you were paying $1 to get 57 cents.
And it gets so much worse when you look at the actual targets they were buying with that diluted money.
Yeah.
The Nikola electric truck example detailed in the book is just jaw-dropping.
It really is.
Nikola was a zero-revenue company that merged via a SPAC, and its stock price rocketed to $73 a share. They released this promotional video of their revolutionary electric truck, quote-unquote, in motion down a desert highway.
It looked incredible on video.
It did. But it turned out the truck didn't even have a working engine. They just towed it to the top of a hill and let it roll down using gravity.
What's fascinating here is that the technology changes, right? But the promotional behavior is identical across centuries.
Human nature again.
Exactly. In the 1920s, Wall Street promoters were selling highly speculative, deeply flawed Peruvian bonds to retail investors who didn't understand the risks. Today, promoters use celebrities, everyone from Jay-Z to Larry David, to endorse SPACs in crypto exchanges.
Because it works.
It does. The celebrity endorsement is designed to entirely mask the total lack of intrinsic value. It is the voting machine operating on pure, weaponized hype.
And if SPACs were Wall Street legally dressing up hype, the crypto boom was what happened when the hype completely abandoned the legal structure of Wall Street altogether.
Oh, completely untethered.
The text goes deep into the mechanics of the crypto bubble Bitcoin, the Luna crash that wiped out 99% of its value, and these so-called crypto banks like Voyager and Celsius.
Those are incredibly dangerous.
They were. These crypto platforms were offering customers huge double-digit yields, implying they were as safe as an FDIC-insured savings account. But the sources show they were actually operating with 19-to-1 leverage.
Which brings us right back to the margin debt lesson Graham learned in 1929. Let's break down the math of 19-to-1 leverage because it's terrifying.
Yeah, please do.
If you put up $1 of your own equity and you borrow $19, you now control $20 worth of assets.
Which feels great on the way up, right? You're making a ton of money.
It feels amazing. But if those assets drop in value by a mere 5%, which is exactly $1, your entire personal stake is instantly wiped out. Your equity goes to zero.
Just a 5% drop.
Yes, and with crypto, you are applying that extreme leverage to assets that have absolutely zero underlying cash flow.
Seth Klarman uses this brilliant, hilarious analogy in the book to describe these assets. He calls them trading sardines.
Oh, the sardine story is a classic.
It's so good. The old story goes that there was a massive speculative frenzy for trading tins of sardines, and the price just kept going up and up. Finally, one buyer decided to open a tin and actually eat one, and they tasted absolutely putrid.
Nest.
Right. So he complained to the person who sold them to him, and the seller said, "You don't understand. Those aren't eating sardines. Those are trading sardines."
That is crypto in a nutshell. You aren't buying it for cash flow or dividends. You are buying it solely with the hope that a greater fool will pay you more for that tin tomorrow.
It is speculation in its purest, most dangerous form.
But this raises a crucial practical question for you, the listener. If crypto is a casino and SPACs are structured to dilute your wealth, does that mean a modern value investor has to completely ignore the entire digital economy?
Right. Do you just stick to buying railroads and tractor companies?
Right.
If we are trying to find intrinsic value, do we just throw out modern tech entirely because it doesn't have physical factories?
Absolutely not. But valuing a digital empire requires upgrading Benjamin Graham's analog toolkit. The core philosophy of buying a dollar for 50 cents remains exactly the same, but how you calculate that dollar has drastically changed.
Let's talk about what that upgrade actually looks like. In Graham's day, businesses were largely analog. Think of steel mills, coal mines, manufacturing plants.
Tangible things.
Right. For those businesses, current assets and book value mattered the most. The literal, physical stuff you could liquidate and sell if the company went bankrupt.
Yeah.
But today, our economy is driven by digital networks and software.
Take a company like Alphabet, Google's parent company. They don't have massive warehouses full of physical inventory that you can weigh on a scale.
Their assets are invisible.
Yeah, their incredible profitability comes from digital network effects and what economists call zero marginal costs.
Zero marginal costs.
Right. If a tractor company wants to sell one more tractor, they have to buy more steel, hire more labor, build it. There is a heavy cost. But if Google wants to handle one additional search query or serve one more ad, it costs them virtually nothing.
It's literally
The
zero.
marginal cost is zero. You cannot value a business model like that using the exact same metrics you use for a 1930s railroad.
So modern value investors really have to adapt. Instead of just looking in the rearview mirror at past physical book value, you have to look forward.
Exactly.
You have to analyze future free cash flow, and you have to evaluate a company's economic moat, meaning how deeply protected is this software or platform from a competitor coming along and stealing all their customers.
And the fact that value investors are doing this deep fundamental analysis brings them into direct conflict with modern financial academia.
Really? How so?
Well, most business schools today teach the efficient market hypothesis and modern portfolio theory. These academic theories argue that all available information is already perfectly and instantly priced into every single stock.
Oh, I've heard this.
Yeah. Therefore, they claim, security analysis, the very thing Graham and Dodd teach, is a complete waste of time because it is impossible to consistently find mispriced bargains.
But the incredible thing highlighted in the text is that value investors actually love that academia teaches them.
Oh, they do. They find it hilarious.
Because if all the bright minds at massive institutions believe the market is perfectly efficient, they just stop doing the hard work. They walk right past the $20 bill lying on the sidewalk because their economic theory dictates that it can't possibly be real, otherwise someone else would have already picked it up.
It is a profound irony. The widespread belief that the market is perfectly efficient is exactly what allows behavioral inefficiencies to persist.
Right.
It is remarkably similar to the paradigm shift we saw in professional baseball, famously documented in the book Moneyball.
Oh yes, that analogy maps perfectly here.
Yep.
In Moneyball, the traditional baseball scouts were evaluating players based on highly subjective, emotional criteria. You know, how athletic they looked in a uniform, the sound of the ball hitting their bat.
Gut feelings.
Pure gut feelings. They were routinely overpaying for flashy trades and ignoring fundamentals. But the Oakland A's started looking at cold, hard data specifically, a metric called on-base percentage.
Which nobody cared about.
Nobody. It was an unsexy foundational metric of true value that the emotional humans in the league were completely ignoring. On-base percentage was basically the intrinsic value of baseball.
Precisely. The baseball general managers were letting human bias and emotion dictate their pricing of players. Finding a rigorous analytical edge works in baseball and it works in finance, precisely because humans are consistently irrational.
Okay, here's where it gets really interesting, though. I understand the Moneyball comparison for Graham's era. Back in the 1930s, you could get a legitimate edge just by digging through dusty library records and corporate filings that nobody else wanted to read.
You had to do the physical
Yeah,
legwork.
you can find the hidden numbers. But
Mm-hmm.
today, every single person on Wall Street has access to the exact same big data. Everyone has supercomputers, AI, instant financial models updating in real time.
Information is everywhere.
Right. So hasn't the edge completely disappeared? How do you possibly find a bargain when literally everyone has the exact same information at the exact same millisecond?
That is the defining challenge of modern value investing. But having access to data is not the same thing as having insight.
Okay.
The edge today is no longer informational. You aren't going to find a secret number buried in a quarterly report that nobody else saw. The edge today is almost entirely behavioral.
Behavioral. Like the psychology we talked about earlier.
Exactly. It lies in having a longer time horizon than the herd. Most of Wall Street is obsessively focused on what a company will earn in the next 3 months.
The next quarter.
Right. If you are willing to analyze what a company's true intrinsic value will be in the next 3 years, you are playing a game with surprisingly little competition.
Oh, wow. Because everyone else is just looking short term.
Yes. The ultimate edge is having the psychological discipline to act rationally when others panic, and the fortitude to hold on to a great business when the voting machine is screaming at you to sell.
The data is completely commoditized, but human discipline is still incredibly rare.
So,
Which brings us to the core mission for you, listening to this right now. The technology changes, but the math doesn't. Whether you are evaluating a 1930s railroad company with physical tracks or a 2020s software company with digital network effects, the rules of financial gravity still apply. Price is what you pay, value is what you get.
you must relentlessly protect your capital. You must demand a margin of safety on every purchase to account for your own blind spots and the unpredictable nature of the world.
And above all, you cannot let the manic depressive voting machine of the market dictate your strategy or your self-worth.
Here, here.
But before we wrap up, we want to leave you with one final provocative thought to chew on. Something that builds on everything Graham taught, but pushes it into the uncharted future.
This is where it gets a little sci-fi.
A little bit, yeah. We just established that having an edge today isn't about having better data, it's about having better emotional behavior. But what happens when human behavior is completely removed from the equation? Consider the rapid, explosive rise of artificial intelligence and algorithmic trading.
It's a fascinating dilemma. If the future of the stock market becomes entirely dominated by emotionless machines, algorithms instantly analyzing data and trading with other algorithms at the speed of light, does the market finally become that perfect, frictionless weighing machine that the academics have always dreamed of?
Or will AI simply learn to replicate our human panic and euphoria?
Right.
If these algorithms are ingesting our social media trends, our news cycles, our historical trading data, do they just become faster, more brutally efficient voting machines? Could AI create market crashes driven by digital FOMO that happen in milliseconds instead of months?
And if they do, will Benjamin Graham's analog concept of a margin of safety become an obsolete relic of the past? Or will it become the only crucial survival tool left in an era of AI-driven flash crashes?
It really makes you wonder. We started this deep dive talking about a gallon of milk and how comforting it is to look at a price tag that is firmly tethered to reality. Graham and Dodd gave us the analytical tools to find that tether amidst the absolute chaos of the financial markets.
They really did.
But as we move into a future where code and algorithms set the prices, you have to ask yourself, in the financial grocery store of the future, are we still going to be able to tell what's milk and what's just algorithmic hype? Let that chew on your mind. Thanks for joining us on this deep dive.